All right, it's 10 o'clock. We've got people logging in as we talk. My name's David Moore with Equity Advantage, and I'm blessed to have two very successful, accomplished people anyway. I don't want to say successful necessarily. Depends how you're going to measure that. But today we're going to talk about some tax proposals that would impact 1031. Obviously, if it impacts 1031, it's going to impact all of commercial real estate. And we've got Les Callahan joining us today, and he's the CEO for First Colony Financial, and also Dan Wagner, who's Chief Governmental Affairs for Inland Private Capital. And you've probably seen me before, David Moore, Equity Advantage. My brother and I started Equity Advantage in 1991, and it was started because we just couldn't get exchange work done at that point in time. But I was talking to Les yesterday about some things. All things CCIM, I guess, and I'd like to just start off talking a little bit about CCIM, and if you're interested, our Oregon Southwest Washington chapter of CCIM has Casey Conway speaking immediately after this presentation. If you're interested in signing up for that, you can just Google CCIM Oregon Southwest Washington. There will be a link to sign up. And I would encourage everybody that has interest in what's going on, all things real estate, to do so. But once again, my background's investment real estate. We've got Equity Advantage, 1031exchange.com, and IRA Advantage that works to take money that was typically always used in Wall Street, IRA 401k funds, and give people the ability to use that money in real estate or anything else that they may choose to invest in. But we're not here to talk about that today. We're here to talk about what potential issues are coming up down the road and how to address these things. And I would encourage anybody that's got a concern about this stuff to take a look at the Federation of Exchange Accommodators website. There's on the homepage, about halfway down, there's a link. You can also go to 1031buildsamerica.org. And that's the FEA website talking about all the details on what we're talking about today. And I know Dan's been speaking regularly on this stuff. Les is the incoming president to CCIM. And so he's obviously got a lot of time he's investing on these issues as well, because it's going to directly impact anybody that works with real estate. So without further ado, I could start off with Les. Les, do you want to do a quick intro of who you are and what makes what you're going to say important, or gives it some credibility? Let's go that way.
Absolutely. So the CCIM Institute was founded in 1967. And when I graduated from college with a political science degree in the early 70s, I wondered what I would do with it. And so theoretically, I thought I might go into banking or whatever, but I ended up in real estate, and I wanted to find a way to differentiate myself. And so really starting in the late 70s, I started taking courses, and I wondered how it would work out. It worked out pretty well because I got to represent several of the European pension funds as they made their first entrees into the United States real estate. And it went so well that a couple of years later, I had a chance to meet some up and coming retailers. So one of those was Walmart Stores, and built the 157th store for Walmart, and then founded my own company in order to do that. So next year, I will have been a CCIM for 40 years. You may notice I'm wearing my CCIM tie. So it's really worked out well for me. So I primarily did shopping center development. Most recently, I've been self-storage and 1- and 2-story office, and now being pulled back into the industrial side. But a little bit more about the CCIM Institute. The Institute is an organization of about 13,000 members, about 8,500 domestic designees, about 1,000 international members. We operate in 8 foreign countries in a big way and about 25 in a smaller way. And then we have about 3,000 candidates at any one time who are going through the system for our core education programs. So we spend a couple $1 million a year in technology, a couple $1 million a year updating the courses, and welcome anybody that wants to follow that. David was kind enough to advertise that, but be happy to help you. The other thing that I always tell people is there are lots of scholarships out there. There are scholarships at the chapter level. There are 54 chapters. There are 130 scholarships, named and out scholarships that are available. There's a veterans program. where we just awarded about $40,000 worth of scholarships to veterans. So we're constantly trying to open up the educational opportunities for folks to help them distinguish themselves. Hope that wasn't too much shameless self-promotion, David.
No, I love it. And just, my relationship with CCIM was started, I don't know, 30 plus years ago. Guy was kind enough to mentor me, a guy named Ron Stash, who was an early CCIM designee. And anytime we'd go into a new city or state to go hunt for some real estate, he'd always pull out that CCIM directory. It's something I wholeheartedly believe in. And I know that a lot of appraisal people, a lot of bankers, they go through the CI classes just to be more prepared with what they're doing too, as well. Wes, and so it's a wonderful organization, and it's definitely something as the market continues to tighten, you better have people that can crank numbers on properties and do it well if you're going out to buy stuff, because the stuff's literally flying off the shelves right now. So, right. Dan, would you like to say a few words?
Well, I just want to first say I'm a little nervous because anybody that's a CCIM, they're like the Green Beret of commercial real estate. So you guys are much smarter than I ever could be. So anybody on this call, you probably want to listen to Les and David more than me. But I'm coming at you live from the wild world of Oak Brook, Illinois, at the world headquarters of the Inland Real Estate Group of Companies. Inland was founded by 4 Chicago public school teachers. They got other Chicago public school teachers to give them money to invest. They did so well. They loved teaching. And the way we got really into the 1031 is we had the teachers get up to 42,000 apartments in Chicago, the largest landlords of Chicago. And when the tax laws changed in the 80s, some of those limited partnerships were underwater. So they they decided they're not going to allow anybody to lose their investment with Inland, because it's their family, friends, other teachers, principals, other folks that they knew. So they put all their money in the company. They went to Walmart and they said, hey, Walmart, we'd like to do sale leasebacks with you. Walmart never did that until they said yes to these guys. And then they went to Treasury, said, hey, Treasury, we want to save these people. We want to 1031 exchange them into a fractional share interest of these Walmarts. Can we do that? Treasury said, nobody's really done that before, but yeah, go ahead and do it. And so they were able to do that, and we're very successful at it. We had that's really the impetus of the 1031 for us, because it was over 50-some years, or 40-some years ago that happened. And our company created then the Delaware Statutory Trust 1031 like-kind exchange opportunities. And my position got created because Mr. Goodwin, the chairman and CEO, said he doesn't want government to happen to him again. They want to be a part of it. And so they created my position, which is very unusual in this space. And what I do is I call myself the canary in the coal mine, to be able to make sure to let folks know what's going on. And then the other thing I do is we get all of our associations, and the National Association of Realtors being the 800-pound gorilla, we get all of our associations that we belong to really help paint the fence for our industry. So we work hand in glove with the Real Estate Roundtable, International Council of Shopping Centers, you name it, IPA, ADISA, all these different groups. But none other than the National Association of Realtors, which obviously CCIM and RLI, SIOR, IREM are all part of it. And it's an honor to be here and talk about something I wish we didn't have to talk about, and that's the capping of the 1031 like-kind exchange. Yeah.
So Dan, thank you. And we've got so much experience working with your firm through the years. It's always been a very positive thing. And obviously the DST world is something that's got a lot of pressure on it right now, especially in regions like we're in, where rent control's virtually wiping out a property owner's rights of ownership. So, which leads me to this. I mean, 1031 historically, as I said, I've been involved with this for 30 years, our business. My brother and I founded in 1991. But every few years we've got to defend 1031. It's 100 years old, and yet here we are yet again. And I wish there was some statute of limitations on if politicians go after something, they got to sit back for another decade before they go at it again. But we had a fight a few years ago when Trump was going through some tax reform, and obviously that state and local tax issue is one of those things that's still a real problem for anybody that's in a state that's got high property values. But this whole issue with 1031 and how it impacts the economy and the government's opinion of what it will do versus the reality of it. Dan was, we were fortunate to have Dan speak in January on this issue, and it was different at that point, right? I mean, if we go back the initial proposals of Biden a year ago, we hadn't seen much change on it. And in January, I think you put out there that it was sort of a situation where we thought maybe nothing would happen because the administration would not want to lose control of the House and Senate. And if the first year was taken up with immigration and COVID, taxation would be coming in that next year, and they wouldn't want to lose control of those two houses. So today we're in a different spot, right, Dan? And you want to just sort of give us lay down where we are and what you're seeing out there, and then we'll get Les to sort of put in there his experience with 1031, the impact of it. And I think the one thing we really want to talk about that people don't think about, and it's really, especially in my region, we've got for multifamily properties, for example, we've got rent control that sort of exempts new buildings, but buildings 15 years or older are the ones that are going to have to deal with all this rent control stuff. And I would argue that the older buildings are the ones that need to be exempted. The new ones shouldn't be, because those value add situations, I would put out there that anytime a property changes hands, it's going to be improved. And that's just my experience, and that's how I got into the real estate world, is buying and improving properties. So we all hear the ads for flipping properties and all that's something that falls outside 1031. But if you look at what that means, though, is you're taking old things and getting them, basically improving problem properties and giving people more opportunity to find places to live in an affordable place versus having to deal with brand new stuff. So Dan, why don't you kick it off, and you can sort of lay the landscape, and then we'll go from there. And I want to say, everybody on this, we've got a good number of people out there today. If you've got questions, I will be addressing them on the side. If it's something that I think we need to have a conversation on, I'll bring it out to Dan or Les. And let's get what we need to done, and we've got roughly 50 minutes to get it taken care of. So Dan, why don't you take off?
Absolutely. So to unpack the beginning part of your information, when I was walking Capitol Hill during the last time when President Trump was president, and the Republicans were looking at reducing all the corporate tax rates to the lowest levels, and they were going to use the 1031 as a pay for. I remember walking into an office, and I knock on the door. I'm like, I'm here to talk about the 1031, and the staff person said, 1031? No, it's 11 o'clock. And so that was a big call for me, because the 1031 is something that is, it's in the tax code, but it's something that nobody really knows about, and it's a continual educational process, so that it's always looked at as a pay for. Over the last 100 years, a new group comes into Washington and say, we want to do this or that, and this is what they look at. So we worked with all of our coalition, the Real Estate Roundtable, and all the different associations, NAR being the grand kahuna of all those, but we at that time recognized we needed to quantify how the 1031 is important. As real estate professionals, we all know the 1031 is important, but we have to explain it and show it. So Ernst & Young did a macroeconomic study, and then Lee and Petrova, two professors, they did a microeconomic study, and then the National Association of Realtors did kind of an overall study. So so we were able to really get some good data. We preserved the 1031 for real estate, for real property, but not for personal property. A lot of the personal property stuff for manufacturing companies and for farmers, for tractors, that went into 100% expensing. So what we're talking about now is real property. We kind of, again, David, we put our feet up on the table and get, we're excited about relaxing. But then the election, the time happened. Candidate Biden said he wanted to cap it. He wanted to get rid of the 1031, raise taxes on capital gains, and get rid of stepped-up basis. He became, as we know, the president of the United States. But what happened is that you have a very slim majority in the House, which was unexpected. There's only 5 seats in the House. And then the Senate became tied, where now Kamala Harris is the tie-breaking vote. The most important thing, though, is a thing called a filibuster. And the filibuster, you need 60 votes to pass something. We have Senator Manchin and Senator Sinema, Manchin from West Virginia, Sinema from Arizona, that says, hey, we're not going to budge on changing that rule, which is a major deal. So they have to have 60 votes to pass anything. So what does that mean? So that means that we are looking at a thing called budget reconciliation. It was something that was passed in 1974 the Budget Act, and basically Congress puts together a budget, and by law it only takes a simple majority to pass it in both the House and Senate. But you can only do that during the budget time. So you have to put, they try to put everything in it. So FY21 budget, President Trump did not get that passed, and so it gave the Democrats an opportunity to pass the 1.9 trillion COVID stimulus bill, and they passed that. And now this is what we're looking at FY22 for this reconciliation package. So after the election and after the dust settled, the Federation of Exchange Accommodators, those are the qualified intermediary national organization. And I know that David was a member of that, or is a member of that, and was on their board. That organization, along with the Institute for Portfolio Alternatives, the Realtors, and all these groups, we started meeting with Democrat leaders. And the people we met with are from the House Ways and Means Committee and the Senate Finance Committee. If you recall back in civics experience in your life, all tax bills originate in the House Ways and Means Committee, and then they get shot over to the Senate Finance Committee. So we've been meeting with a lot of the Democrats on those committees. And one of the things, I'm a cup as a half full guy, so we had the president announce in April that he wants to cap the 1031 at $500,000. So the good news is that he didn't eliminate it. So that's a positive. We got him from getting rid of it to getting it to where we're going to cap it at 500,000. And at that point, we didn't know if it was going to be retroactive or not. So that made everybody nervous in the world. Then you had the Green Book come out. That's where they really puts pen to paper and they highlight this is what we want to do. And it's more of a political document. I mean, if you think about it, President Obama, at every year of his budget, he said we're going to cap the 1031 at $1 million every year. And the world didn't go crazy because they knew it's a political document and like, we're not going to do that. Nobody ever even thought about it. But because politics have changed and the dynamics of the world are different, now it's become a big deal. President Biden's Green Book that came out Memorial Day, Friday before Memorial Day, said that we're going to cap the 1031 at $500,000, but we're going to also now allow your spouse or your partner to be able to have $500,000. So it's really $1 million a couple. So they did that. And then he also highlighted it's not going to be retroactive, that for 1031s, you're going to be able to do them up to December 31st of 2021, just as you've done before. But starting January 1st of 2022, that's when it's going to kick in. That is not what he's doing for capital gains taxes. So capital gains, he's going to raise to 39.6. You add the Obama medical device taxes, 3.8%. That brings it to 43.4%. And it all depends what state you're in and what the state tax is. But obviously, that's a major issue for the world. But he said that is going to be retroactive back till April 28th. So if he does, all this gets passed, then starting January 1st, you got to go back and pay all those taxes that you owe from your federal tax. So that's kind of what's going on, and I can get into all the other aspects of what we're doing to fight this. But the biggest issue is the studies that have been out there are super important, where you show that when owners own something, they're going to maintain it. Buyers renovate, and that's where this huge world of economic impact happens. Ernst & Young and their macroeconomic study identified that, just as you said, David, when you're able to use pre-tax dollars and you because you're going to pay the tax, but use the pre-tax dollars to renovate stuff is what happens. And because of that renovation of all these different properties across America, there's 580,000 jobs that would go away if you got rid of the 1031. And you also have the issue of taxes. A whole bunch of taxes, your transfer taxes wouldn't be happening, the recorder fees wouldn't happen, and then the income tax that gets created from all those different jobs. So in DC, one of the terms is the juice isn't worth the squeeze. And clearly for this issue, the juice is not worth the squeeze, because President Biden's Green Book said that it's going to be $2 billion a year is what it's going to provide for funding for the 1.7 or 1.4 trillion or whatever trillion amount they're at right now. It's only going to be $2 billion a year. The Ernst & Young study said that on a conservative side, you're going to lose $17 billion a year in taxes across the country. So again, the juice isn't worth the squeeze, and we're trying to explain that to folks. And the idea that why did the Democrats even look at this? What's going on? From what we can gather, it's basically the idea that this is a Donald Trump thing, and that this is a big thing for very high-level commercial fat cat people. And we have been across the board meeting with all these different elected officials saying, no, it's in diverse areas. It's utilized to bring capital into underserved populations. It's used for REITs, and REITs provide tons of income for pension funds, and it's used with conservation. I mean, so on and so forth. There's lots of stuff that we could go into, but overall, that's the big picture. And in order for us to really wake up all of our elected officials, all of us are going to have to get up from our couches and actually get engaged in this. And David's been just fabulous to do this, and there's nobody better than CCIM to get the word out. So with that, I will yield the floor, and our good Mr. President-elect of CCIM, if you're ready, go ahead.
Okay. And I haven't been briefed by the NAR legislative team since Tuesday, so I'm probably a little bit out of date as we continue to go forward. Dan, one of the things that you touched on was the importance of being knowledgeable about the changes in the law and being participatory in the process. So I would encourage everyone who's listening here in some way, shape, or form to get involved in one of the CRE trade associations and find a way to have your voice heard. Now, some people get more money, some people get less money, some people get time, some people get both. But Capitol Hill visits by NAR are just huge. The last time we did that in 2019, it was 2 long days for me. I visited all 14 of the congresspeople congresspersons from the state of Georgia. We have a slight Republican majority. I still visited with the folks on the other side. We all have our preferences, but telling the story is such an important part. Participating both in your local politics, but also in the national politics forward. Dan also sort of touched on the smorgasbord of taxes which the Biden administration would like to impose. Increase ordinary income tax, increase in capital gains, elimination of step-up basis, changing the gift tax laws, and 1031. So as I look at the wonderful career that real estate has provided for me, in some way, shape, or form, I get touched by all of those in a really big way. I don't know that all of them are going to get passed and all of them are going to get passed in the way that we think, but the thing that really fuels real estate, commercial real estate, of course, is the 1031. So I told David a story that I think is sort of an example of why this is so good. So, everybody talks about SPEs, single purpose entities, and every CMBS lender in the world likes that. Well, I'm in the opposite side of that because what I started doing, my first exchange was in 1994, and I'll come back to what that was about. And I have continued to roll forward 3 partnerships which collectively have more than 50 assets. So every time I go look at loan documents for a lender and they say, well, where's the SPE? I get to say to them, look at all the assets that are in there. I would be crazy to drop this thing into bankruptcy. I would be absolutely crazy. My life would be miserable, and you would spend a few legal fees, but I would spend a fortune. So I built a blockbuster in a small town about 150 miles from Atlanta, a little town called Milledgeville, Georgia, which was great. Had 3 shops in it, including a Domino's Pizza. Today, that particular entity owns 23 assets, about 1.2 million square feet of space, where there have been 7 or 8 different exchanges carrying forward. I look at the number of people that are employed to do roof repairs and take care of the parking lots, the number of accounting people, the property management people, all the jobs that are created in that portfolio. So 1031 is very near and dear to my heart. And I look at the unrealized gains that have been carried forward. And in the next step, of course, is step up in basis of death. those are very, very important things, and the 1031 has gotten me to a point where I have a high-class problem to deal with, and hopefully that we can convince both the House of Representatives and the Senate to give us some relief there.
Right. So the thing that sort of worries me is we've got an incremental sort of shift, right? And Dan talked about, the proposals and the limitations that are there. But if we go back, to 17, and we lost all the personal property, and I'll blame the OZ for that. So the old opportunity zone, I think, was put in place in lieu of us being able to do personal property. Now, personal property, to be honest with you, it was probably a lot of the 1%ers that we did a lot of work with in that space. We did lots of jets and helicopters and cars and collectible cars and stuff like that. So, I can understand politically it was probably low-hanging fruit for them to knock off and take it away. I would put and stress the fact that 1031 is sort of the blue-collar tax treatment. I mean, it's something that's so inexpensive to do, and anybody can do it. And most of the time people start with their first investment house is their primary residence that they outgrow. And after they've moved out of it, after, let's say, 3 years, that 2 out of 5 that Section 121, the universal exclusion covers, no longer applies to that thing. But typically, my experience over 30 years is we have so many people that have started with little things and been able to grow their portfolio, and at some point they probably end up talking to you less about some bigger stuff, or Dan's firm. And Dan's firm we're doing a lot work with these days, just because people can't afford the liability, honestly, of renting a single family residence along the West Coast. It's just getting to that point where it's too much for individuals to actually deal with. And I see sort of a fundamental shift in ownership. And I think the government likes it, and we hear about firms buying up entire neighborhoods for 50% over market. And I think there's lots of people out there that just want tenants to be tenants forever. So I think that's ultimately where a lot of damage is going to be done. 1031 is not something that is just for the wealthy. Like I said, it's for people. Anybody can do it, and it's an easy process, and it's pretty transparent. But my concern is we lost personal property a few years ago. Now they want to put a cap on it. And these caps, if you look at Section 121, the 250 or 500, you've got the exclusion on a primary residence. Those numbers were good in 1997. They're no longer any good today. And my concern is, and I've talked to Dan about this, it's like I sort of look at 1031 as an IRA or 401k for real estate. And I hear Wall Street people saying, well, gee, we don't have a 1031, but the thing that people don't understand is what percentage of money on Wall Street is qualified money, which has automatic deferral. And if we take 1031 away from the real property, we don't have anything there. Now, the other difference is that the Wall Street stuff, you're not paying tax on unless you're selling it. Real estate you're buying, you're paying property taxes on it every year you own the thing. So if you've got income being generated by the property, you've got exposure. If you've got all the taxes on that thing every single year you're paying things forward on this stuff, and it's different than Wall Street. So that's why 1031 is there. But the ultimate impact, I just want to stress, historically we said, look, this is not as Dan said, a pay for. It's not going to give the government money over time. It's actually going to cost them money. But the biggest thing I really want to stress is that it's going to hurt the quality of property. I mean, you've got a situation where everybody can drive by a piece of property the owner doesn't want and know that. You can see the things just falling apart, and that thing might not be safe. I mean, I was talking to somebody yesterday, and we're just talking about lead paint. We don't talk about that much anymore. But as I said, my background was flipping properties. I buy things, and I wouldn't flip per se in a flip, because if I flip properties, it's normal income tax, and I can't do an exchange. So that's a double whammy bad. So we'd always buy, improve, cash out, refi, hold it a few years, and then do the exchange. But the idea is to keep that portfolio of property inhabitable and in good condition. And the only way that's going to happen is people's liquidity. You got to give them a way to get out of these things. And so, Dan, as far as these other proposals or less, I mean, what percentage of your transactions are 1031s?
Probably a quarter, I would guess, from what we see. We've benefited from bonus depreciation. In some cases, we've had properties in inventory for a period of time where they may be fully depreciated. So the 1031 is a way for us to continue forward, and it's great. But also to your point, David, this whole idea that we've got sales tax being paid for by the tenants, we've got property taxes. In some cases, we've got only rent taxes in lieu of property taxes. It's one of the most heavily taxed industries in the entire world. We pay our fair share every year. And now to load onto that, the inability to carry forward that gain, when in fact we are improving the properties, we are adding to the value, we're adding jobs, we're adding other economic growth. It's just incredible. So, Dan, you ran through the numbers pretty quickly. So, give us a sense of what the revenue would be with the end of the two surveys were on the end of 1031. I want to make sure I got the 2 billion versus the lose 17 billion.
So is the juice worth the squeeze? I love that line in Washington. So that's what a lot of people like to highlight. So President Biden's plan is to cap the 1031 at 500,000, $1 million for a couple, and they said that's going to be worth $2 billion a year. Ernst & Young did the study, a macroeconomic study, and they said conservatively the government's going to lose $17 billion a year from lost taxes, from all the the jobs that get created because of the 1031, so the income tax, and then the transfer taxes when you buy and sell real estate, recorder fees, and the depreciation recapture. So that on the light side at 17 billion, they think they can make a case for 30-some billion, but I'm sticking with 17 to be conservative. So it's a net loss. The big issue, though, among the Democrats that we talked to is the idea of equity and wealth, and wanting to try to have everybody to be as equal as possible. And this is where I think what's been helpful in a couple examples is to highlight that if you cap it at 500 and then it goes to $1 million, which is not very much, especially on the West Coast, but really most places. You might have people that do, that they might repaint something, they might do some things on their own, but the real big velocity of those jobs and those numbers that we're talking about comes from the big projects. So I was on with Congressman Danny Davis, who is from the south side of Chicago. So this gentleman, David Doing, he took this vacant land. Mayor Daley chopped down some tenement housing called the IDB Wells homes, and they sat vacant. This land was vacant for 15, 20 years. Nothing was happening. This David put in this food desert. There was no grocery stores. He put in a really nice Mariano's, and before it was completed, he had this big New York firm came and they 1031 exchanged and shot a ton of money into the south side of Chicago, into this they call it Bronzeville. And that's a big issue in underserved areas. Getting capital into those places, is a big key. And you wouldn't, if you didn't have a big project, you wouldn't have that kind of, energy and amount of capital going in to make a big change. The other example I love to give is Naperville is the second largest economy in Illinois. So you have Chicago, and then Naperville is a suburb of Chicago. The mayor of Naperville spoke at a congressional hearing with the Real Estate Roundtable a few weeks ago, and he highlighted, he's like, Dan, could you find out from just one of the large qualified intermediary companies how many 1031s they've done over the last 5 years? So this one company ran the numbers, and in Naperville alone, they did $450 million worth of 1031s. The mayor was floored. He's like, oh my gosh, you mean there's all this stuff is happening without the government being involved? We're not, no one's coming to us with their hand out to the city saying, hey, we need money to renovate our medical office building, whatever. It's pre-tax dollars. Just as David said, it's a 401k of real estate. You're using pre-tax dollars. It'll get eventually paid, but they're able to use that money to renovate, and that creates jobs and everything. And so he then highlighted that another thing that happened is there was this obsolete Kmart along a big, very popular commercial area of the town. And this old guy had this for years, had this old Kmart, and now it's just this dilapidated strip shopping center with a couple, a nail salon here, or, something, tarot card reader there. And he was able to, instead of condemning the property, they were able to work with Costco. Costco came to this old guy and said, hey, 1031 exchange out of here, which he did. And now Costco's ripped everything down. They're building up a Costco, going to hire people. And then that sales tax is going to help reduce property taxes for the city, for the school districts. It's just a phenomenal thing. And then inland, we owned a big shopping center on the south side of Naperville, and one of the Dominic's, one of the grocery stores went dark, and then there's a group that 1031 exchange and bought the property and then turned it into a really nice shopping center, and that would never have happened without the 1031. So the mayor really loved that, and then so that's where we highlight that's not, that this idea of capping is not the thing to do, because you're not going to get these big hits into an area that you expect, and the amount of jobs it impacts. But then I went to the IBEW, the International Brotherhood of Electrical Workers. I went to the group that represents our DuPage County, which is just right outside of Cook County here, and they're really big. And I said, hey, I was thinking that the jobs was going to be their big issue, and I'm like, look how many jobs get created. They said, Dan, we like jobs, but really for us, for private unions, the pensions are a big deal. Private unions, he said, their pension fund is over 80% funded, which in Illinois is unheard of for public employee union pensions. And he said, for really, if you can show me how the 1031 is impacts REITs, because they have a huge amount of their investments in REITs for their pension funds, that would be of interest to him. And so we got Baker McKenzie to do a white paper, and they did a beautiful white paper. We sent it off to him, and he said, by God, clearly the 1031 is impactful to REITs because to reposition their portfolios, and it helps to increase, obviously the return, and that's what it's all about, is return on investment, because all of his electrical workers that are retired, they rely on that pension check for their groceries. And this is, it's really, that's why this thing's been in the tax code for so long, because it has so many unusual reaching areas that people don't think about. And then this whole other area, the Realtors Land Institute have been fabulous. Aubrey Cabernis is the CEO there. We have talked to so many wonderful brokers who have done deals where they've had Birds Unlimited purchase just huge swaths of land in the West for migratory birds. They had in Colorado a couple, I think 1,000+ acres that were 1031 that ended up being part of a forest preserve, and that adds to the water that gets filtrated, that goes into the Denver for Denver citizens to drink. Out in Florida, there's a rookery that was created because of a 1031. I mean, there's so many examples of this, and so. The interesting thing is that the Nature Conservancy and the Conservation Fund is a part of the coalition to defend the 1031, and they, that's been a big important deal for people, because they recognize that, especially like in Oregon, the 1031 is so important to the timber industry, and the timber a warehouser, I believe, is out there, and that's an important thing for people to be aware of. So the timber. The owners are very much engaged in wanting to protect the 1031. So it's all these unusual things that people don't pay attention to, and you have to educate these members of Congress so that they understand what the overall impact would be. I'll tell you another quick story. We met with Mike Thompson, represents Napa Valley, and he's 100% believer in 1031. He's a Democrat, and he's like the #2 guy on the House Ways and Means Committee, and he's one of the big champions to protect the 1031. And again, I think with all of us working together, I think we're going to be able to protect it. But one of the things that you guys can go to is if you go to www.ipa.com/1031s/, that will bring you to a website where you can type in your address, and it'll send off an email to your member of Congress and to your 2 U.S. senators. So it's www.ipa.com/1031s/, and that's a big deal. Eventually, the NAR we're looking at them doing some sort of call to action, but there has to be a bill first, because they're such a large organization to do that. But if we can get this done before anything is put into a bill, that's going to be one of the keys that we're trying to do right now. And these elected officials, they understand that the president has put forward this very robust agenda that's incredibly progressive and very changing of the way we've been running the United States. And they kind of behind the scenes, a lot of these folks want our help to really wake folks up, because Les, as the incoming president of such a powerful organization of leaders, David, with all the years of experience you've had, I mean, it really is incumbent upon all of you guys, and then everybody that to really educate their member of Congress and say, this is what will happen. I mean, that don't attack the ideas that they want to do. There's nothing wrong with wanting to give free college, free healthcare, free whatever. I mean, you're not going to debate that. But what you want to just highlight is that the things that you want us to do, that's going to impact us. So that I talked long enough.
Yeah, thanks, Dan. So I've got a couple of people asking about whether we're going to get those links or materials out. We'll follow up. CC in my office, when she sends out information after this is completed, we'll include some of the links that Dan just mentioned. And the other one is at 1031buildsamerica.org. That's the FEA site on this, and it's got the same type of links to the representatives. Les, when I talked to you the other day, you talked about the unions as well. So I mean, your experience with them, I mean, you're dealing with larger assets, and you probably echo Dan's comments on that. And actually, just before you answer that, I just want to stress what Dan said about the capital gains proposal. You cap 1031, and then you start looking at a federal tax rate that's what do you say, 39.6.
39.3.8.
Yeah, and then you add another 3.8 for the healthcare tax on top of that. And then in Oregon, we've got another 11%. They're talking about going to 13 on top. You're not going to sell anything. I mean, it's just to combine the tax increase along with this thing is just going to be brutal. Les, why don't you make comment whatever you'd like to say on the union interaction and so on. Then we've got a couple questions that I need to get you guys to answer.
Let me make three quick points. First of all, as an investor outside of our core retail and suburban office portfolio, we also invest in other transactions. And so, for example, I'm an investor in a project in Covington, Kentucky, right across the river from Cincinnati, which is a union process. And it took 22 months to build the same project that was built in 14 months in Savannah. But that's another story. We're in the middle of, CCIM Institute is in the middle of doing a study to determine within our membership what the band is, what are the size of the deals that are being done by investors represented by our members. And what we're finding is that band is between $3 and about $7 million. So the gain is, of course, maybe 25% of that would be an example. But that study will be out, Dan, in a couple of weeks, and I'll be happy to share that with you. So, there is some inherent expense with exchanging 200,000 proceeds and trying to go forward. And that's still an admirable goal, but a challenging one. But that it seems that a lot of people really, once they get into that sort of $1 million in cash plus debt, it's not quite, not competing with the institutions, going forward. So it's that $3 to $7 million band is really, really a big part of it. And the last point I wanted to make is doing an exchange is a lot easier. And David, I think most of the people on this call either have tried an exchange or have done an exchange. But at some point in this call, you might explain to them kind of how easy it is, because it's easy.
Yeah. So Wes, it's sort of funny because, going back to when we, the early 90s and you put 1031, people were so leery putting 1031 in we all had those RMLS books and other books. They didn't want to put in their term or condition of the sale or purchase was 1031 because if you go pre-91, you could identify a county. So the old saying with buyers are liars, would definitely apply in that situation. You're just IDing a whole bunch of properties and you happen to be the listing broker on the other side. You might not have been very happy with that situation. But I would argue that in today's world, you've got a 1031 buyer. That's a more sure-footed offer than somebody walking off the street making an offer. So, I mean, you've got a definite situation where you've got timelines that have to be met and strict guidelines that we have to follow that's going to move that money forward into the replacement assets. So, with that said, Dan, you talked about retroactivity on stuff, and I'll just say, right now, we're running about 3 times our normal volume right now. And it's because, like the title of this presentation, should I stay or should I go? We've got so many people moving assets, trying to get where they need to be before the laws change. And we had those questions on retroactivity of 1031. I said, well, I don't know how they'd ever go retroactive on that, because if they did, it would just put a bunch of people into bankruptcy. You're now triggering a tax when everything was deferred. They've spent the money. How do you take that away? But if we look at the retroactivity of maybe the tax on disposition, that's a different deal. Either way, it's a dangerous issue. But with that said, I've got a question, and either one or both, if you want to answer it. Is the 500K proposed limit per property per year per something else? And the second part of that question is, if the 500 applies to husband and wife each, do both need to own the relinquished property or just file jointly?
Well, that's, the details are still undetermined in some aspects. The experts that I've talked to is that it's going to be 500,000 per year, not per property. So it's you can have up to 500,000 for a 1031 in gain per year, and that's that. And other than that, there's not really much more to go on.
So Les, if they put that 500 per year in, I mean, a natural consequence of that action would be selling a tick interest in something, right? You break a major sale into fractions over a series of years. I mean, I can see people doing that just to get within those limits. So originally we were thinking it's per transaction, but now we're hearing it with just annual. Is correct, Dan?
Yes.
Yeah, I mean, one of my anecdotal stories is in 1986, I built a multi-tenant warehouse project, and it's run along at about 70 or 75% occupied. Well, recently it became a last mile project. Who would have thought? And so now I've got some bright young folks that think they can do a whole lot better with it than I have done in the last 35 years, and have offered more money than I ever won.
Yeah.
So it's under contract. And I'm of course sitting here with seller's remorse, wondering whether I really should have taken it out to the market or taken this off-market offer and selling it. But I follow the 1031 very, very closely because the partial exchange into a tick interest at $500,000 may be, for this particular partnership, may be exactly the only choice that I have. And to try to find some way to do purchase money financing, there's a significant amount of equity to do purchase money financing, and try to time those tick interests with the payments that are received from my purchaser. So we're having a conversation with tax counsel about how that would work, and saying, please don't give me the money now. Please give it to me over a couple of years so that I can learn the system better.
Interesting. So sort of question that follows up, we've got one question stands out to me is about ticks, partnerships, and fractionalization. Is if a $5 million property was sold with 10 partners, could they all fully complete a 1031? And so obviously you're just looking at if you break it. And I could see if let's say the 3 of us own an asset in a partnership, you're going to see lots of drop and swaps pre-disposition, right? Because that entity is going to have the tax hit, or the members of the entity would with the drop. So that's 2 totally different situations. I think that sort of is what's being asked in that question. Any comments by either one of you on that?
Well, but I guess one of the things I will highlight is that if all this stuff goes through, which I don't think it will, but the president also wants to have much more vigorous IRS evaluations. They want to really increase the amount of staff and everything. So from the people that I know in Washington, they want to figure out every possible way to get that money for the health care, for childcare, for free college. So the ideas of being creative, I believe that they're going to make rules. I think they're going to try to stop a lot of that from happening. So I would just caution you on anything you do, because they're going to want to really unusually go after stuff that, yeah, I don't think we've ever seen anything like this before.
But specific to your example, David, depending upon the entity structure, if it is a general partnership, the idea of distributing assets to the individual general partners so they each have a piece is a typical tax structure where they individually do the thing, right? And I don't want to give tax advice to anybody. Now, when you go to LLCs or you go to entities where you have general and limited partners, it becomes much more complex to do that, and there's much greater audit risk and potential penalties going forward. But to Ian's point, whatever you're going to do, I would do it sooner rather than later, because the enforcement mechanism is going to be much stronger in the next couple of years as more agents are hired and more returns are audited.
Thank you. So, gents, as far as obviously the other things that NAR's obviously got to be concerned about is a stepped up basis, and then the capital gains tax rates. What are your thoughts on those two things going forward? Are they going to happen, or what are the odds? I mean, I've heard comments, Dan, that maybe we just have appreciation tax to, bumped another 5% so it matches depreciation recapture too. But to bump it all the way up that 39 number would be a very, very tough thing for people.
So what I think is the Speaker, Nancy Pelosi, understands that they have the House by 5 votes, and if you go to Las Vegas and you're a betting person, you're going to bet that the House is probably going to switch to Republican in 2022. If that's the case, if you ever played Hearts, it's called Shooting the Moon. I mean, they're going to try to do everything they possibly can, and they're going to throw everything at this as they possibly can. So anyone that thinks that, this might not, probably won't go through, or going to wake up the next day saying, oh my God, what happened? I think we have to take everything they say very seriously, and that this is the agenda and what they want to do, and it's up to us to not sit back on our couch and think, NAR is going to do this for me. Dave and Les and Dan, they're going to do it for me. This one is different. It's a different era. It's going to take every single person on this call that's listening to me right now. Really, you got to go to that website. And then you also have to, if you can Google, once you find out who your congressman or woman is and your senators, you need to make a call into those offices, because those numbers that they hear of how many emails they got, how many calls they got, are a really big deal. And then there's this is going to sound weird, but the 6 degrees of separation. You have to think, who knows this congressman or woman? Do I know the dad or mom of this person? And I was talking to Phil McGinnis out in Delaware, and we were having a conversation yesterday, and I said, boy, we got to get to all the senators, all the Democrats. He's like, well, I know the Democrat senators here in Delaware. I'm like, well, how do you know them? Well, they lease from me. They're upstairs in my building. I'm like, oh my God. You got to go up there and let them know in the 1031 that they shouldn't do. They can't do this. And so that's the kind of stuff that has the really, really big impact. And it'll blow your mind if you can figure out your networks of friends and family, but get those websites, get them to your clients, get them to your relatives. We got to get people, jazzed up to understand it. And, some people said, well, Richie Neal's the chairman of the House Ways and Means Committee. I'll just call him. That'll be meaningless, because unless you're a constituent, they won't care. The biggest issue for the elected officials are who they represent, and they really do care about the voters. Even if it's someone who is diametrically opposed to your ideals, by you sending those emails and by calling, it still creates cognitive dissonance within their office to know that, oh my gosh, there's all these people that are against it. There must be a reason for it. If we all just sit back and don't do any of this stuff that I'm talking about, then we are not going to be successful. And the way that our American society has been run for all these years will definitely change. And the 1031 is going to be plus the stepped up basis, and all that stuff is going to be really difficult. With stepped up basis, the Farm Bureau, the farmers are going a million miles an hour to defend the stepped up basis. Right now, the president, they're talking about having stepped up basis where you can still keep it if you continue with your farm. So basically, farm kids, if they want to do something different, will never, they're not going to want to ever sell because they won't be able to have the money to pay for it. Or if farmers do sell, it'll end up being big conglomerate organizations buying the property because no one else could get it. So it blows your mind the different changes that'll be happening in the way things are done.
Yeah. Les, I mean, with the stepped up basis and the capital gains tax increase, and if they cap it, I mean, you're working with bigger assets. What's the NAR's position on the obviously stepped up basis and all, and how would it impact what you guys do? And we've only got about 3-4 minutes. I want to get us wrapped up, so we'll want to go to the next one.
Can I go back? Dan's comment was participation. Participate at every level. I will tell you that through 5 o'clock yesterday, the NAR Present Circle, which is the high-end givers to RPAC, have reached 278% of their goal for Joe Manchin. Pick your candidates if you don't want to participate on a personal basis. If you don't want to get out there and tell your story, respond to calls for action from your trade association, whatever that is, whether that's NAR or whatever. The step up in basis will have a huge effect. I look at the estate planning of my clients, and many of them are trying to max out their gift tax in this year. They're going to do it, hoping that it's not retroactive. That piece maybe is a next year piece or a date of enactment. But there are huge amounts of assets that are being moved into subsequent generations right now. Big thing.
Right. And are we hearing any talk about the old SALT issue, Dan, the state and local tax that got the cap that Trump administration put in place? Because I know, especially in the blue states on the left coast anyway, those numbers don't mean much. But is there any talk, Les, if you've got any comment on that too? Is there any talk of a change in with SALT or not?
Well, go ahead, Les.
Go ahead. What I was going to say is, you got the 5 things that Dan and I have outlined as tax changes. And so nobody's talking about SALT, because what's going to happen is when they can't get one of those 5, they're going to say, all right, well, I'll give you that one, but here's what I want. I want SALT now. And so it's going to come back and get you coming back the other way as a trade.
Right.
SALT is just too big of a number for them to mess with. And from the AOC part of the world, they don't see, from an equity standpoint, they're like, why would you care about rich people being able to deduct more from their taxes? So philosophically, it goes against some of the progressive wing of the party. But there's some elected officials that said they're not going to budge on it. My guess is that they'll probably throw them a bone and increase it a little bit. I mean, they'll probably do that.
10 to 20 or something. Yeah, that's what I'm hearing.
So we've got 3 minutes. I'm gonna wrap it up. I guess what my final comments, and I'll let each of you guys say something too. But as far as this stuff's concerned, I think you need to heed the warnings that the tax consequence would be retroactive 1031s. If you're going to do something, if you're thinking about contemplating a move, you probably ought to do it sooner rather than later. And I think that there's lots of people doing that. So we will be sending out, again, links to the tax reform sites. Les and Dan, if you want to open up any other inquiries to you, I mean, we can send out a link to your emails as well. But I'm just going to thank both of you for participating today. And any last comments you've got there, Les?
Yeah, I was just going to say, and Dan, you're going to laugh at this. The whisper number I'm hearing on 1031 is 2 million and a 28% capital gains rate.
And so I believe we're going to make sure to not have a cap at all. And I think that with everybody working hard, that www.ipa.com/1031s/ if everybody does that, I think we're not going to have a cap. And God bless you all, and we're all in this together. So make sure the Kipling said the strength of the wolf of the pack is the pack, and the strength of the pack is the wolf. So let's do it.
Well, thank you very much, everyone out there, for joining us today. Thank you, Les and Dan, for participating. I really appreciate it. And once again, I want to stress CCIM is a wonderful organization. And you know, if you're looking for people in different regions, it's a great place to find good qualified brokers to handle your transactions. Dan, we always appreciate working with your firm. Thank you for taking the time. And hopefully next time we get together, we won't be talking about this issue. We'll have succeeded in defending it. But thank you, everyone, and look forward to working with you. The only dumb questions one's not asked. So if you've got questions or concerns, please don't hesitate to reach out. We will, as I said, send the links out. And thank you so much, everyone. Appreciate it. Have a wonderful day. And if you're going to head over to Casey Conway for the Oregon Southwest Washington CCIM chapter, look at that. I think it'll be a very good presentation too. Thank you. All my best of health to everybody out there, and have a great day. Thank you.
Thanks so much.
Thanks. God bless.
Bye-bye.